The G7 countries want to limit the amount of money Russia can make via a price cap on Russian oil. They passed the sanctions package on Tuesday, which included this measure. If you are affected by fuel prices, I suggest you watch the interview about the topic on DW News from September the 9th. On the other side of the line was Professor Jeffrey A. Sonnenfeld, a renowned professor from Yale School of Management. Let me summarize it for you with some updates. Crude oil can only be legally bought from Russia by EU members under the price cap starting from December the 5th. Furthermore, refined products like gasoline will be banned with some exceptions from February 5th, 2023. The question is, how does this affect Moscow and prices? According to Professor Sonnenfeld, Russia is a very inefficient oil producer. The only places they can sell it in big quantities currently are China and India. They are getting so big discounts that Russia is just about break-even, so while the revenues are high, the profits are not. How do we know this? We know what a country is paying for oil from entities that handle third-party logistics. Ships, financiers and insurers are usually from the EU or UK. We know that India went from close to 0 to 1 million barrels of Russian oil per day. Since it's India's primary interest to buy cheap oil, as stated by their energy minister, they are likely to go along with the price cap. However, India's reserves are filling up. There have been reports in the second half of September that their purchases are already slowing. China, of course, has the same incentive, and since there have been multiple showcases of Chinese-Russian friction, we have no reason to assume China will support Russia in this question. Currently, China and India receive a $35 discount on oil that usually costs $85 a barrel. It costs Russia $44 to $45 per barrel to extract the oil and another good amount to do the logistics. This results in a barely profitable business. The US White House also wants to reduce Putin's biggest source of revenue, so they are on the side of the EU, UK, China and India too. According to them, the discounts show that Russia is willing to swallow a lower margin because they are reliant on global demand. Professor Sonnenfeld said that we don't want to allow OPEC to drive up the price of their supplies, so we do want the Russian supply on the markets for balance in the long term. Putin said that they will only supply oil if their economic incentives are met. According to Sonnenfeld, Moscow has to sell because Russians cannot drink the fuel and it is one of the main sources of income for the Kremlin. These are good points, however, earlier this week Russian officials met with Saudis and agreed on a supply cut. This would raise OPEC oil prices and give Moscow some leverage to base their discounts on. There is already talks from the US government of countermeasures. To hedge against energy price growth, I hold shares of the energy ETF XLE. Subscribe to learn more and earn more.